I call Stuart Nash.
Thank you much, Mr. Chair. I just want to just build on a little bit about what Mr. Farfoy said in his first contribution. You know, GST, it's generally recognised that GST should apply evenly across all consumption. GST is what they call basically, well, it's a domestic, you're taxing domestic consumption. There's the destination principle, which means you tax the good or the service in the country within which it is consumed. Makes sense, we all understand that. And that is why this tax has been brought in, and this is why we do have such a problem with the non-taxing of tangibles, when we think it could have gone a lot further. One of the interesting things that the IRD commented on, Mr. Chair, is that they said the proposals could impact on the level of competition by discouraging offshore suppliers from entering or continuing to supply the New Zealand market. However, this impact may depend on the extent to which the compliance costs are imposed on offshore suppliers and the extent to which consumers alter their purchasing behaviour in response to the change. Now, I don't know if that's put in as an advantage or as a disadvantage. I would say that if this sort of law encourages New Zealanders to actually purchase domestic intangibles, which is what we're taxing here, then surely that is not necessarily a bad thing, because what we absolutely want to do, as I would have thought, is encourage New Zealanders to purchase domestically. And in fact, as mentioned, one of the principles about this is fairness and equity, and the IRD talks about fairness and equity a lot. One of the things that came up a lot in the Select Committee, Mr. Chair, was the effectiveness and fairness of this option. And we talked long and hard about this. And one of the big questions, I suppose, is would offshore companies actually pay this? You know, how could we be sure that a Netflix or an Apple or any other large supplier, they reckon about 100 companies, would actually comply? And the interesting thing is when we looked at overseas examples, offshore suppliers, and we were told that particularly large international suppliers account for the majority of these cross-border services. And I think if we think of, you know, of Apple and downloading oceans, etc., that's probably right. We were told that they have a willingness to comply. And we were told that for these suppliers, failure to comply with their obligation would pose a significant risk to their reputation, which I suppose could be right, but it's an interesting comment when you consider that the Googles of this world, Facebook, Apple, they don't pay any tax anyway. They don't seem to care that their reputation may be sullied because they don't pay tax in a country because they live on the strength of their brand. And they've all got massively valuable brands, and it's why they can get away with paying no tax. Where this sort of falls over is Starbucks in the UK, when they were actually shamed into paying voluntarily paying more tax because there was a consumer boycott of their stores. And that's the power, I suppose, of consumer action. But I doubt, and I could be wrong here, but I doubt that companies like Apple, like Facebook, like Google, really care about their international reputation in New Zealand on whether they pay tax or not. Now, that may change when a lot of the OECD work on base erosion, profit shifting comes to fruition. But at this point in time, I think what they care about is the goods and sales that they can sell into the country. Mr. Chair, I'd like to talk about the impact of this and some of the underlying data around it. There is an acknowledgement, and I think it's fair enough, that because of data limitations, it's not possible to accurately determine how many offshore suppliers may be required to register and return GST. But experience in similar countries, the IRD have calculated it's probably around about 100 offshore suppliers may register for GST. And again, owing to the data limitations, we just don't know the value of offshore purchases and how much money this will bring in or how much we're missing out on. Again, the best estimate of the IRD officials is around about $270 million is purchased. It's quite a lot when we think about it. And that's purchased on services and intangibles. We're not talking about tangibles here, just online stuff. And the estimate means that there's around about $40 million of GST that is foregone on these purchases. And again, there's an estimate that this is growing, online purchases growing by around about 10%. Isn't it interesting? We think of $40 million in foregone GST. And this is only on intangibles. Imagine what it would be if we charge GST on tangibles. I think you'd find it would at least double on that, Mr Chair.
Joe Hayes.